What effect will the election have on Bay Area real estate? The answer will surprise you. I'm Melanie Giacomo with Real Estate Experts. We are going to talk about that and so much more in our summer market update and forecast. Well, year to date, our market continues to be steady in spite of some of the economic headwinds we've had with inflation and, most importantly, political uncertainty. Now, in order to understand why our market has been steady and resilient, it's important to understand the big picture of Bay Area real estate. What you're looking at here is the last 40 years of real estate prices and their increases in and around the Bay Area. Now, one of the things that we enjoy here in the Bay Area, and like to call it the Garden of Eden of real estate, is because we have seen 50% price appreciation every 5 years and 100% every 10. It is exactly double the national average of appreciation for other markets across the country. Most places really see around their 40-year average is about 3.8%. Ours, you can see on that nice upward trend, is about 7.66% annual average over 40 years. Now, why do we see double the appreciation? Well, the answer is pretty simple. Because we consistently have half the amount of supply as other parts of the country. Half the amount of supply, double the amount of price increase. So then where are we today? Well, year to date, Bay Area home prices are up 3.9% since January. Now, I will remind you, I said our average appreciation is 7.6%, and half of that is 3.85. So we are right on track for where we should be with our annual appreciation. So what is it that's continuing to drive prices higher in the face of increased interest rates and a little bit of political uncertainty? Well, it's best for me to explain this and keep it simple by saying real estate is a supply and demand driven market that is tempered by interest rates and our stock market. So let's take a look into what's happening and what's going on and driving prices behind this. So supply, when we look at supply, this is looking at the last 5 years of Bay Area real estate. And you can see what's happening with supply. It's consistently gone down, down, down. When we see a little bit of an increase this year, but it is still below our historical averages. Well, then where is it going? Part of that is it's going to be taking a look at demand. So supply is down, increasing slightly, but what's happening with demand? Well, it's all a function of how many people are moving into or out of the Bay Area. And this is a quote from Silicon Valley Index, who tracks migration and the economy. And they said the net migration in Santa Clara and San Mateo counties combined was positive, meaning that the number of people moving in exceeded the number of people moving out for the first time in 8 years, with a net migration of 1,800 families in the last year. So that's good, but what does that mean in relation to new housing that is being created? Well, this graph here shows the number of new home permits being issued in the Bay Area, and what you see is the red arrow pointing there. That's the number of single-family home permits. So although 1,800 families moved into the Bay Area, only 500 new permits were issued. The rest of those being housing permits, where the light purple colored line is, you see there, that's for multifamily apartments. So we still have very low supply. We have more demand, but based on the number of people moving here, we are chronically in low supply. Now, other factors we talked about are interest rates and the stock market. So what's happening with the stock market? Well, here's an interesting stat to consider. 62% of the value of the NASDAQ exchange is located within 20 miles of Mountain View. And the NASDAQ has been up 43% since November. And if we look back 18 months, it's up over 70%. And if you happen to work for one of those high-flying AI companies like NVIDIA, just this year alone, your stock would be up 175%. So seeing that the majority of the home buyers work in technology in and around the Bay Area, many of them are feeling confident and flush with cash, meaning that their pockets are full and they're ready to put more money down on a house. And that's what has continued to drive up prices in the face of higher interest rates. So then this is looking at the NASDAQ index. Just since November, it's up 77%. So then what's happening with interest rates? Well, the real question is, where are the rates actually headed? Here's the forecast looking from the perspective of three of the major mortgage forecasting outlets. First is Fannie Mae, second is the Mortgage Bank Association, and third is the National Association of Realtors. Today, you can get a 30-year fixed jumbo loan right around 6.5%. If you get a traditional 30-year, it's around 6.75%. And the forecast, as you can see from this quarter going into the next quarter and even into the next year, is a general trend down. So the good news is these analysts, after looking at all the economic data, are forecasting there's a 60% chance that the Fed will make a rate cut in September. They've held rates steady for the last few meetings, and it does look like it's time for the Feds to make a rate cut. So what we will know that happens with a rate drop. Experience tells us from decades of market data that when rates go down, money becomes more affordable. The monthly payment goes down for people and pushes prices up. So that's what we're going to see happening with rates. Now, what about the election? Well, this is an interesting fact. Looking at the last 8 presidential elections going all the way back to 1989, the market data shows us that in the election years, prices actually go up. And in fact, they have gone up every year after the election as well. Except for that one year where you see there's an orange bar, that was in 2009. And that was in the year following the Great Crash. That was the only time we saw prices decrease after an election. So experience tells us there's a strong likelihood that we will continue to see prices increase this year and into the next year. So answering this question of where is the market headed? Well, here's our forecast for this summer. Rates will likely drift down as inflation seems to be calming and trending down. Demand for homes will be steady because the job market is good and the NASDAQ is doing amazingly well, filling those pockets for buyers out there with cash in their pockets for payments on these homes. Supply will increase modestly as more sellers begin to list their home. They realize, hey, if we're going to make a move, rates aren't really where they want to be. They're not in the 4s and 5s, but we've got to make a move and we're just going to bite the bullet and do it. And lastly, prices will rise another 3 to 4% as we are forecasting, just as we do with our 40-year average, because demand is and will continue to exceed supply. So what does this mean for you if you're a buyer or a seller? Well, the most frequent question we get is, should we wait for interest rates to come down or for the election before we buy? And before I answer that question directly, I want to explain to you what happens when rates go down. When rates go down, demand increases because buyers now have lower monthly payments that they are looking at and they can qualify more, and then they jump in. Supply goes down because there's more buyers entering the market, buying up those homes. And the third thing that happens is prices rise because demand is exceeding supply. Buyers are competing and you will face multiple offers, typically following a rate cut. But I want to urge you that if you've been waiting, here's another reason why now might be a good time to keep searching. This graph is telling us the last year in the fall, 3 out of the 4 buyers put their search on hold. And the top 4 reasons why buyers stopped their search is because buyers thought rates were too high, they couldn't find home prices in their range, or they were competing with too many offers, or they just couldn't find the right home. And they thought it would be easier to wait until next year. So the question is, should you wait? Well, let me ask you a question. Would it be easier to buy now when there's actually some more inventory in the market There's less competition at the moment because rates haven't come down substantially yet. So would it be easier to buy now when there's more selection and less competition, and then simply refinance to a lower interest rate when you're already moved into that home? Or would it be easier to wait for rates to come down, maybe at the end of the year, and get back in the market when the election has passed, the buyers are back, competition is fierce, and the prices are higher? What is better for you? Well, our expert advice is that if you are considering buying, buy now before the coming frenzy, after rates come down and the election is behind us, because it's going to be easier to do that. One narrative we are hearing in the industry for people that have been in it for a long time is they say, you know what, this feels a lot like 1995. In 1995, we had just come out of a recession, rates had come down from 12% down to 8%, and the economy was just starting to turn around. And looking at our 40-year chart, this is what happened after 1995. We entered a 7-year run where prices increased 100% over 7 years. Now, I don't have a crystal ball, but what I can say is that the conditions that we're facing now are very similar to what we experienced in 1995. Now, if you'd like to explore your individual situation and circumstances to determine if making a move now or later is the best for you, please get back to me so I can help you make that decision. Until we talk again, this is Melanie saying we will be here when you are ready to help you create a better life through real estate. Have a great day.